Hello and welcome back. Today we're jumping right into a technical analysis of Redwire Corp, or RDW. The report argues that $8.01 is a hard floor, setting up a reversal toward a $12.50 target.
Yeah, it's a very clear thesis, and I have to say, the material does a fantastic job of translating chart action into a really compelling story.
It really does. But we're here to push it to the next level, so let's get into it.
I think the first place to look is that very energy you mentioned. It's a huge strength, but we need to manage it carefully.
Right, so the core idea here is that the report's powerful, high energy, and, contrarian framing. While super engaging, it occasionally risks overshadowing the objective technical analysis it's built on.
Exactly. It's a question of perception. You see this really urgent, evocative language.
Oh, definitely. Calling the drop a crime scene analysis, for example.
Right, or a stop-loss hunt. And that rejection at $9 is called the trap.
It's very dramatic.
It is, and that creates this powerful narrative of market manipulation or psychological games, which is great for grabbing attention. I mean, it really works.
But
the document is supposed to be a technical analysis report. And for that kind of material, that urgency can subtly chip away at the perceived neutrality, the objectivity of the data.
it suggests an emotional stake in the outcome, right? Before you've even laid out all the evidence, it sort of shifts it from a study to an opinion.
You've hit it exactly. If I'm a portfolio manager, I want to know the analysis is pure, that you're not just framing data to fit a cool narrative. That phrase, crime scene, that immediately signals to me that this might be an opinion piece first and a technical analysis second.
Which is not the goal. The goal is forensic rigor.
Yes. So the big question is, how do you keep that magnetic quality without losing credibility?
And the suggestion there is really about structure.
It is. The idea is to reserve that high-energy, contrarian commentary for the intro hook and the final strategy section. Where you're grabbing attention and then laying out the trade.
But the middle part, the engine room.
That's got to be sterile. The detailed technical arguments, the gap fill, RSI cooldown, the $8 floor, they need to be presented with strictly neutral, data-driven language. That's what preserves the report's credibility as a serious analytical document.
It's like you have to earn the dramatic payoff. The objective analysis has to be the foundation, and it has to be completely solid.
A meticulously prepared forensic review. That's the feeling you want.
So let's get concrete. That section on intraday price action. The heading is the crime scene analysis.
Yeah, that heading carries a lot of baggage. A simple fix could be changing it to something like intraday volatility study, the support test.
That's much cleaner. Objective. The word study itself just elevates the whole thing.
It does. And you can apply that same thinking to the language inside the section. The report says something like, amateur traders chase the morning spike.
Right.
And look, that might be an accurate read on market behavior, but the analysis is stronger if you just replace that judgment with pure observation.
So instead of calling them amateurs,
You just say, high volume activity followed the morning spike near $9, preceding the subsequent sell-off. That confirms the facts, volume and price, which is what TA cares about, without judging who was doing the trading.
that's a great point. The technicals should work no matter who's on the other side of the trade. And that small change, it really does elevate the tone.
It does. It goes from a subjective take to a verifiable data point.
And speaking of verifiable, that got me thinking about the quantitative muscle behind some of these claims.
I'm glad you brought that up, because if we clean up the language to be more objective, we have to be absolutely sure the numbers back it up.
Right, and that's the second big point. To really elevate the robustness of this whole thesis, key observations like the RSI cooldown and the institutional floor, they need more explicit, quantifiable details.
Yes, the concepts are so strong. Gap fill, psychological support, RSI reset, all great technical ideas.
But they feel a bit like assertions right now. They're missing the proof of magnitude.
Exactly. Take the RSI cooldown. The report says a 6% drop resets overbought conditions. Okay, but resetting from an RSI of 71 down to 65 is totally different from resetting from an extreme 85 all the way down to the 50s.
The context is everything.
It's everything. Without knowing the previous RSI level and the range it cooled down into, the claim is just hanging there. You haven't proven that enough energy was gathered for the next big move.
And that lack of specificity, it just invites doubt into the thesis. Some analysts would say an RSI above 60 is just consolidation, not a full reset.
And the same logic applies to the $8 floor. It's currently just labeled as whole number psychological support, which is a valid concept for sure.
But the analysis calls it an institutional floor.
And for that, you need more than psychology. You need evidence of demand, of actual, large-scale money stepping in to defend that price. Psychology is the idea. Institutional volume is the proof.
So the challenge is turning a strong concept into a data-supported fact.
That's the whole game. The suggestion is just to strengthen these sections by adding specific metrics. That's what grounds the interpretation in explicit data instead of, these general concepts that could apply to almost any stock.
Okay, so let's apply that. Argument 3, the RSI cooldown. How do we make that provably successful?
You just need to specify the range. For example, you could say something like, the 6% drop successfully cooled the RSI from its previous overbought reading of, say, 73 back into the healthier 50-60 consolidation range.
Ah, okay.
See, that sentence immediately tells the reader you've done the work, it validates that the shakeout was effective, and it gives them confidence the momentum has actually been reset.
It turns a soft indicator into a hard confirmation. I like that. Now, what about that $8 institutional claim? How do we get past just the psychology?
Well, this is where you bring in more specific volume tools, right? Technical analysts use tools that aggregate order flow to confirm these levels.
Like a volume-weighted average price, VWAP, or maybe time price opportunity charts?
Exactly those. So the material could suggest, corroborate the psychological support by examining the volume profile like VWAP or TPO charts around the $8 zone. That would demonstrate the actual clustering of limit buy orders that caused the bounce from $791.
If institutions really were defending that level, you'd see it in the volume profile. It would be dense right there.
It would. And that transforms the claim of an institutional floor from a concept into a provable reality. It just makes the whole analysis so much more robust.
That's a huge step up. And it's a perfect lead into our third critique, which is all about justifying the endgame, that 1250 target.
Yes, because this is where you tie the low-risk entry to the ultimate payoff. And the point here is that the analysis report successfully incorporates a strong fundamental backstop, but it currently separates these fundamentals as a quick reminder rather than leveraging them to fully justify the ambitious 1250 price target.
Yeah, I saw that. The report is very clear. The technicals identify the entry point between $7.80 and $8.10. And then there's this separate section, the fundamental backstop, quick reminder, with all this great stuff, space infrastructure, 50% revenue growth, growing backlog.
But that separation creates this minor but really critical disconnect.
How so?
Well, the 1250 price target is just cited as the analyst average price target. It doesn't connect it back to the report's own fundamental points. It's almost like saying, buy here because the chart looks good and just trust other people on where it's going. You need to own that target.
Right. So the argument is only compelling because the underlying company is robust and undervalued at $8. And by treating the fundamentals as like an appendix, you miss the chance to show the engine that's actually going to drive the recovery.
Mentals are there justifying a much higher valuation. If you're going to argue for an insane risk to reward,
Risking 50 cents to make $4.
then you have to fully validate why that $4 gain is achievable. The technicals find the floor, but the fundamentals define the ceiling.
So the suggestion is pretty straightforward then. Integrate the fundamentals directly into the trade setup section.
Yes, use the company's growth to validate the long-term price target. Show that the technical floor is a great entry point, specifically because of the underlying value. It's about showing the confluence of technical timing and fundamental power.
Okay, so in the trade setup, the report has that line. The risk to reward ratio here is insane. Risk 50 cents to make $4. That's a great hook, but we need to back it up right there.
Exactly. Let's make that connection explicit. In that section 5, the trade setup, you could just expand that discussion slightly.
We could just weave the facts right in, something like, the risk-to-reward ratio here is compelling because the $1250 analyst average target is strongly supported by the company's documented 50% year-over-year revenue growth and expanding backlog.
Confirming that the technical consolidation at $8 is happening at a fundamentally undervalued inflection point.
That's it.
That one addition completely transforms the $12.50 target. It's no longer just a cited number. It's a goal that's intrinsically supported by the analysis itself. It validates the whole thesis. It even makes that $7.50 stop loss feel smarter because you know the underlying value is there.
Perfect.